Chapter 14, Leverage and Margin. Section 2, Margin Requirements. Margin is simply part of your own money that gets set aside to support a leverage trade. It works like collateral, not a fee. So while the position is open, those funds are reserved, and if they are not lost in the trade, they become available again when you close it. Two margin terms matter at different moments in a trade. Initial margin is the minimum you need to open the position, while maintenance margin is the minimum equity you need to keep it open, and if your equity drops below that maintenance level, the broker may step in. Margin requirements also limit how large a position you can control. Because the requirement is calculated as a percentage of the trade's full notional value, a lower margin percentage lets you control more exposure, while a higher percentage reduces your maximum position size. Margin requirements are not the same everywhere. They can change based on the asset you trade, how volatile or liquid the market is, the broker's own rules, and whether markets are under stress, which is why the same account can face different margin demands in different situations. In practice, margin follows a simple workflow. You calculate the notional value of the trade, apply the initial margin rate, open the position and track the used margin, then keep watching equity as profits and losses move while checking that it stays above maintenance. Let's make that concrete with Maria's Euro/USD trade. She opens a 100 S/Euro/0 unit position at 1.1 thousand, giving her a notional value of $110,000. With 3% initial margin, she needs $300 from a $5,000 deposit, leaving only a modest cushion if the market moves against her. A small loss does not automatically mean trouble. If Euro/USD falls to 1.800, Maria loses $2,000 and still has $3,000 of equity, which is above her $200 maintenance level. But if the pair drops to $1, $100 maintenance level. But if the pair drops to $1, her equity falls to $1 and the broker may issue a margin call or start liquidating the position. One of the biggest misunderstandings is thinking margin limits how much you can lose. It does not. Losses come from the full market exposure of the position. So a leveraged trade can burn through posted margin quickly, and in some cases losses can exceed that amount. The same logic shows up in a stock example. A $10,000 deposit with a 40% initial margin supports a $25,000 buy dollar position or 500 shares at $50 each, and if the price falls to $40, the market value becomes $20,000, leaving $5,000, leaving $5,000, ultra 5% maintenance requirement. Most margin problems come from underestimating exposure and leaving too little room for normal price movement. So remember the basics. Margin is not a fee. Calculations should use total position value. Rules can differ by asset and broker. Requirements can change. And it is smart to keep a cushion above maintenance.